Good evening, everyone. Welcome to yet another edition of Market Insight webinar. Myself, Niranjan, product specialist at UTI AMC. Today, we bring you a nuanced asset allocation approach to investing. And most of us understand that different asset class like equity, debt, gold, etc., behave differently to economic cycles. However, timing economic cycles of such asset classes may not be easy for most of us. So we have Mr. Shravan Goel, Head of Passive Arbitrage and Quant Strategies, who is the fund manager of UTI Multi-Asset Allocation Fund as well. And he will actually today take us through the asset allocation model that is followed at UTI and how the strategy aims to balance risk and reward. Before we jump there, we also have our Chief Investment Officer, Mr. Vetri Subramaniam. He will actually take us through the key macro changes and share updates on the equity markets. So over to you, Vetri sir. Thanks.
Sure. Good evening, everybody. Delighted to be here again on this edition of the monthly webinar. And thank you, Niranjan, for that introduction. And of course, today, as he mentioned, Sharwan is with me on this call, and we'll be covering the multi-asset allocation strategy. But as usual, I'll just kick off with the markets. So Niranjan has put together a presentation. This is our standard deck. We start off with a few insights into some economic and market trends, and then we go on to look at where we are in terms of valuations and what are some of the strategies that we are positive about at this point of time. And then, of course, we'll hand over to Sharwan, who will talk about multi-asset. So without any further ado, we'll just move into the first slide. Now, this is a very interesting slide because remember that it's now almost 5 years since, 4 years since the COVID pandemic. And interestingly, I also put out a commentary about stock price performance in the post-COVID era over the last 4 years. Do take a look at that. That's on our website. But here we are going to be talking about something different, which is not stocks, but about countries and their response to the pandemic. Now, what most countries did in response to the pandemic was essentially use the fiscal to support the economy. So the fiscal deficit went up in most cases. And when the fiscal deficit goes up, because you are effectively borrowing money, the debt to GDP also goes up. Now, of course, over here, we are looking at non-financial services debt. So this means this is the debt of households. Households may have also resorted to debt because during the pandemic, they didn't have income. Businesses did not have revenue, so maybe they also had to access debt, and governments also added on debt. So what this chart shows you is the table of where was the debt to GDP, non-financial services debt, as a percentage of GDP in 2019, where was it in 2023 December, and what was the peak number. And what you can see over here is that in every economy around the world, there was actually a significant increase in debt as a percentage of GDP. And of course, by the time you get to 23, the number starts to pull back down. I think what is most remarkable, and at least from an India point of view, what is good to see on this chart is, of course, in India's case as well, we do have an increase in the debt to GDP compared to where we were in 2019. But the good point is that on an absolute basis, non-financial services total debt to GDP of the Indian economy at about 169% is much below comparable numbers for other economies that you see here, particularly the most indebted, of course, being Japan, followed by China, and US not too far behind because they are still continuing to run very large fiscal deficits. So this is just a sense of how governments and other constituents in the economy, households and businesses, had to raise debt to survive the pandemic, and how their numbers are looking post-pandemic. On the next slide, we have just dived in to look more closely at only two economies. One is India, the other is China. And you can see the overall debt to GDP of India and China on the left-hand trajectory. Now, what is interesting over there is that when you look at the numbers, you will see that China's number actually starts to take off after the global financial crisis. That is not a pattern which actually happens in India. India actually tends to stay flat. But China's debt to GDP starts to explode after the global financial crisis. That is when they actually also had this huge property boom, which was the way that they used to ensure that the economy continues growing, because exports, even though they were growing, the bigger contribution actually came from investments, and investments were driven by real estate. And that is why actually their household debt and other numbers start to really spike up very, very significantly. And therefore, by the time you get to 2023, China's debt to GDP reaches 311% of GDP. India's is at about 175%. Now, some of these numbers may look slightly different from the previous slide. That's just because of a difference in dates and difference in terms of the data providers. But essentially, directionally, there is no big difference between the two numbers in terms of the way they are behaving. On the right side of the slide, you can also see the overall split of debt. Right. So who exactly is holding the debt? Now, what you can see over here is that in India's case, of course, it is dominated by debt of the government. That's almost equal. So debt of government is 83% of GDP. Households and non-financial corporations are again equal to about 85-86% of GDP. In China's case, government debt is actually lower as a percentage of GDP, but households are far more indebted and non-financial companies are significantly leveraged. But I must point out that in China's case, many of their companies which are leveraged actually belong to the state. They belong to not the central government, but to their individual provinces, as they are called, or to local bodies. And these are the entities that have typically leveraged up very aggressively for developmental purposes. But be that as it may, you can see that therefore the non-financial corporation number of debt is really the very, very big number as far as China is concerned. So this is just the difference between the two. Pure sovereign debt to GDP, both economies are comparable, but on household and non-financial corporation, China is far more leveraged. So these are just two big pictures that we wanted to share with you in terms of where we stand in terms of debt post the COVID period. On the next slide, we are going to change gears completely and talk about Nifty 50 earnings. These are the numbers as of a few days ago. Now, the Nifty 50, as you know, is actually 50 companies. As of this date, we had the numbers only for 28 companies, but you can see the quarterly trend line both for Nifty EBITDA and for Nifty PAT. So for the 28 companies that had reported earnings for the fourth quarter of financial 24, earnings were up about 13% year on year, decelerating from the peaks of 20% that we saw in the July quarter of 2023. Remember, when we've talked about these earnings numbers in the past, what we've said is that financial year 24 was not a year in which revenue growth did very well for corporate India, but it was a year of margin expansion. But I think by the time you get to Q4 of 24, a lot of the margin expansion is now in the base, and that's why you're starting to see this slowdown in profit growth for the Nifty 50 companies, 28 companies reporting. And hopefully when we talk in June, we should have this chart updated for all 50 companies in the Nifty 50. Moving on from this, we'll move on to some of our more traditional decks and slides that we update. I'll jump through this slide and the next one. Nothing much to really say on these two, just a standard depiction of performance. But yes, here we are on the slide where we talk about earnings, and of course March 24 estimates at 18% growth. Remember, the fourth quarter number for 28 companies is 13%, so you've seen that acceleration through the year and it's slowing down slightly. The expectation is for 13% growth in earnings for March 25 and 15% earnings growth in March 26 for the Nifty 50 companies. Moving on from this, if we just look at the EPS numbers for every year, you can see that the FY24 EPS number, some companies yet to report, actually has been very stable. From June 23 to May 24, the earnings estimates have more or less stayed stable. And even if you look at the FY25 number, there's not much difference between the estimate that was there in June 23 and what we have today in May of 2024. It's more or less a straight line. But this is also unusual because in India, typically over the period of a year, we actually see earnings estimates getting cut. That did not happen this year. Moving on, we'll now take a quick look at valuations. First, we have the trailing valuations of the Nifty 50 on the left. You can see that's in the fair value territory. However, when you move to the forward P multiple, you will see that it is now in the expensive zone. The yellow line is the long-term average. The red line is one standard deviation above the long-term average, and current valuations are above one standard deviation, which puts it in the expensive zone. This is on earnings. What about price to book? That's visible here, and you can see price to book, which actually stayed in fair value territory for 21 and 22. In the last 6 months has pushed up aggressively, and now even price to book on the Nifty 50 has actually moved into expensive territory, and you can see it there at 3.7. The long-term average is about 3, so you're almost 20% higher than the long-term average of 3 in terms of the price to book of the Nifty. Of course, on the right hand side, you can see the return on equity. This is one of the best return on equities we have seen, going back all the way back to the pre-pandemic period, all the way to 2013-14. So that also in part reflects one reason why that price to book is much higher. Moving on to the mid cap and the small cap index. You can see that in this case, both indices are trading in very expensive zone in terms of price to book. Equally remarkably, if you actually look at the number, 4.77 times price to book for the Nifty mid cap 150, 3.94 for the Nifty small cap 250. The absolute number itself is much higher than the Nifty, which is at about 3.7 times. So this is unusual. This is a premium, and this is something that investors need to keep in mind when they are making their financial planning and allocating towards funds. On the next slide, we'll move on. This is a comparison of a more tactical indicator at some level. This also is an indicator which feeds into our multi-asset fund asset allocation model, which of course Sharwan will be talking about later. But simple point to make here, this indicator is now in that orange territory at the bottom. This is an area where actually fixed income is slightly favorable as compared to equities. Equities are said to be favorable when that chart is in the green zone. But now we are well in the orange zone. We are at about minus 2% yield differential. The long-term average is about 1%. On the next chart, we have another version of Nifty 50 vis-a-vis Nifty mid-cap. Now, this is actually a very long-term chart going all the way back to May of 2005. And you can see that in the long term, the average premium of the Nifty 50 to the Nifty mid-cap is about 4%. But currently, the Nifty 50 is actually at a 23% discount to the mid-cap index in terms of its P multiple. And when you see those gray bars, that's the premium that the Nifty 50 has to the mid-cap index. The green is the area where it trades at a discount. We've been trading at a discount to mid-caps for a very long period of time, all the way back to 2021. And this is something investors should consider, because I would believe that, mean reversion in valuation cycles is very common in the stock market. And that's something one should be wary about. Very quickly, moving on to, sort of my final slide. The US Federal Reserve, of course, had its meeting last week, and they, clearly dissuaded the market from expecting a rate hike, which is quite strange because in January this year, the bond market was talking about 5 to 7 rate cuts in the US. And now the bond market is saying at best we might get 2 rate cuts, maybe even less than that. And in fact, in this meeting, the Federal Reserve was at pains to tell the market, look, hike is not even on the table. So that's the extent to which the narrative has moved in a 4-month period. But equally interesting, we have talked about the challenge facing the US Fed. One, rates are high. They're not able to bring it down because of inflation. They're having to hold the policy rate high. Equally, they are trying to sell their existing bonds, which are sitting on their balance sheet because of quantitative easing that they did in the past, which means the US has got a large fiscal deficit. The Treasury sells a drink, and the Federal Reserve saying that we will slow down the bonds. I think they realize that their sales are pressurizing long-term yields in the US, and obviously they don't want that. So they actually indicated that they would now slow down the pace of bond sales. In India, the March CPI came at 4.85%. All of you who track this data will know the MPC's target is 4% plus or minus 2%. RBI governor has actually been talking about 4% being the target. Given that, it is not a surprise that in its last meeting, the MPC remained in pause mode. And I think they will very clearly now sort of hold to the second half of the year before they do anything. And certainly they would want to see how US policy develops rather than preempt. Though very interestingly, yesterday, we actually had the Swedish central bank actually cut rates, which makes it one of the first central banks across the world to actually cut rates, one of the tracked central banks to cut rates. But I would still submit that, that is a very long shot in India at this point of time. We've already talked about earnings growth for the fourth quarter and the earnings expectations. We've talked about the dichotomy in valuations, the mid cap and small caps trading at a big premium to the large cap. So our recommendation to investors is to continue with a staggered approach. If you're doing SIPs for the long term, it doesn't matter. But if you're looking to invest lump sum, we would recommend going through a STP route over 6 to 12 months. And the bias is towards large caps simply because we think there is relative valuation comfort in large caps relative to the small and mid caps. Those looking to do lump sum investments, the equity allocation strategies where we manage the allocation level to equity, such as our balanced advantage strategy, the multi-asset allocation strategy, and the equity savings funds. These are strategies that investors might wish to consider because here we will manage the equity allocation based on what our model tells us is the attractiveness of equity valuations. And I'll let Sharvan talk about that later. In the sector and thematic space, one sector idea that we feel very strongly about is the banking and financial services space, where we think companies and their company valuations are attractive in large part. And secondly, their balance sheets are very well positioned, and valuations being what they are, we actually think this is one of the sectors which can stand out in terms of its outperformance to the market as a sectoral theme over the next 1 to 2 years. Healthcare, slightly more of a relative call, but we still think the sector in terms of its past track record is not trading at a very expensive premium. There is some defensive characteristics. Some of the things happening in the sector, including global and local market trends, are playing to their favor. So more a relative call, but we think healthcare is also reasonably well positioned. And finally, those of you who have listened to me in the past will know that we launched an innovation fund in the second half of last year. This is by definition a slightly more risky strategy because it is investing in a very focused list of companies, less than 30 holdings. But these are companies which are disrupting businesses, very innovative in their business models. Many of them are platform businesses, B2C or B2B. And while this will be a more volatile portfolio, we think this is a portfolio portfolio strategy where investing through the SIP route is a good idea. So that's about it from my side in terms of giving you an overall perspective. I'll now hand over to Sharwan, and Sharwan will talk in more detail about our asset allocation strategy for the multi-asset allocation fund.
Sure. Thank you, Vetri, for sharing your insight on market outlook and various facets of the market. So today I will talk about UTI multi-asset allocation fund. So when it comes to long-term wealth creation, generally people talk about stability of returns over long period of time, because apart from long-term wealth creation, it is very important that journey of wealth creation is also stable. So that's why UTI multi-asset allocation fund, which provides access to three different asset classes which are having negative or low correlation to each other. So when we look at broader asset classes, then equity as an asset class has long-term wealth creation opportunities, but at the same time, this particular asset class is pretty volatile from short-term perspective. When it comes to fixed income, it helps generate wealth by generating stable returns over long period of time, but at the same time, volatility is also lower. So objective of investing in any fixed income is moderate return with lesser volatility, while gold as an asset class is having negative correlation to equity, right? And because of which it helps us sail through better during turbulent equity market environment. Typically, every 3-4 years, market corrects 15-20%. And in such market environment, gold provide protection. So that's why the role of gold in portfolio comes into play. Moving on. Right. So here we have plotted equity, fixed income, and gold performance or different events that we have witnessed in the marketplace in last 20 years. As you can see that every 3-4 years, equity markets are correcting somewhere around 15-20%, and at times it is correcting much higher. And each such cycle, gold and fixed income is delivering positive return. So that's the role of fixed income and gold, and that's the role of asset allocation, and that too dynamically managed through a asset allocation model. So, for example, during global financial crisis, when equities corrected 52%, gold delivered positive 32% return. Similarly, during COVID, when markets corrected 37%, fixed income and gold returns were positive. So, whenever markets are going through tough time, typically other asset classes are providing you protection. So that's where a combination of different asset classes which are having negative or low correlation to each other helps us generate stable return over long period of time. Right. So if you look at performance of various asset class over long period of time, so here we have plotted 25 years outcome of equity, fixed income, and gold. So in last 25 years, equity as an asset class has delivered 14% annualized return, but volatility of this particular asset class is pretty high at 22%. As compared to equity, fixed income has delivered 7% return, but volatility is also significantly lower, while gold is delivering double-digit return, but volatility is somewhere between equity and fixed income. But when we combine these three asset class in different proportion, then you tend to generate stable outcome over long period of time. So for example, a portfolio of 65% equity, 25% fixed income, and 10% gold would have helped you generate 13% annualized return in last 25 years, which is just about 1% lower than equity. But at the same time, portfolio volatility would have been significantly lower as compared to equity, just about 14% as compared to 22%. In UTI multi-asset allocation fund, rather than keeping asset allocation stable, we are changing asset allocation based on relative valuations approach, right? And because of which fund could generate slightly better returns as compared to stable or static equity allocation. Can skip this, right? So in UTI multi-asset allocation fund, we have three asset classes. First and foremost, equity, wherein gross equity allocation is always more than 65% to get equity taxation benefit. So UTI multi-asset fund is a equity-oriented hybrid funds with the equity taxation benefit. So always we are maintaining more than 65% equity allocation on gross basis. But when it comes to net equity allocation, the equity allocation range varies from 40 to 80%. Fixed income and gold allocation varies from 10 to 25% each. So equity allocation is dependent on 4 valuation oriented factors. So we studied various factors which are influencing forward market return, but we found that these are the 4 factors which are consistently having very high correlation with 1 year forward Nifty returns. Because typically we have seen that market tend to revert back to mean valuations, and depending upon different macroeconomic environment, valuations could trade at expensive valuation, or whenever people are fearful regarding a lot of negative news coming up from global side, mainly because of geopolitical risk or global markets heading towards tough time, typically valuations trade at cheaper valuation. So any asset allocation based on these four valuation oriented factors could have helped you generate slightly better outcome as compared to stable or static equity allocation. So we are using these four factors, which are having consistently high correlation with 1 year forward Nifty returns. And in the sense, these four factors are complementing each other. Typically, any asset allocation model which is based on a single factor, which could face volatility associated with that particular factor. Since we are using multiple factors which are related to each other, at the same time, they are having their own characteristics. So, in the sense, stability of the model is far more superior using four factors rather than using one single factor. While when it comes to gold allocation, it is based on gold to equity ratio, which shows relative performance of gold vis-a-vis equity over long period of time. So based on gold to equity ratio, we are deciding gold allocation. So gold allocation varies from 10 to 25%. In last couple of years, we have seen that gold has been pretty volatile. And we have seen that multiple times our model has suggested either 10-15% gold allocation or 20-25% gold allocation. We'll talk about this particular ratio in subsequent slide in details. Right. So in this particular chart, we have shown model equity weight. At the same time, we have also shown 1 year forward Nifty returns. I mentioned that typically market has a tendency to revert back to mean valuation. Over very long period of time, it could tend to stay away from mean valuations depending upon equity market environment, but it tends to come back to mean valuation. Here also you can see that the blue line keep moving from low to high, high to low, depending upon market environment, right? So one such example was COVID, wherein equity markets have corrected just about 35%, and it was trading at extremely expensive valuation zone. As you can see that during March 2020, equity 1 year forward Nifty PE was around 11 to 12 times. And at that point in time, our model suggested highest equity allocation of about 80%, because at that point in time, market valuations were extremely attractive. Similarly, post-COVID, we have seen that there was very strong rally in the marketplace, and valuation moved from one extreme to another extreme. From just about 11-12 times 1 year forward P ratio, valuation moved to about 22 times 1 year forward P ratio. And because of very strong return within 1 year period, valuations became very expensive, and our model systematically started reducing equity allocation. And when markets were trading at peak somewhere around December to Jan 2020, our model suggested equity allocations of just about 40-45%. And thereafter, we have seen that markets went sideways. There was hardly any return made on equities for about 12 to 15 month period. So markets keep going across different based on different macroeconomic environment. Market keep moving from one extreme to another extreme, and our model is capturing that by changing equity allocation based on relative attractiveness of equity as an asset class based on four factors. Moving on. So here we have shown how our equity allocation has changed in the last 15 years. And at the same time, what was the return of Nifty in next 1 year period. So as you can see that whenever our model is suggesting higher equity allocation, generally 1 year forward returns tends to be better. And whenever our model is suggesting lower equity allocation, because our model will suggest lower equity allocation whenever markets are trading at expensive valuation zone, at that time, typically 1 year forward returns tends to be lower than average. And the current equity allocation suggested by the model is about 47-48%, mainly because broad equity market Nifty is trading at 15 to 25% premium as compared to longer term average based on the various valuation oriented factors, and because of which our model is suggesting lower equity allocation within a range of 40 to 80%. In the bottom table, we have shown performance of the model. So whenever model has suggested 40 to 50% equity allocation, generally next 1 year returns tends to be lower. So average 1 year forward return whenever our model is suggesting 40 to 50% equity allocation is just about 5.7%. On the contrary, whenever model is suggesting higher equity allocation of 70 to 80%, On an average, 1 year forward return is 34.7%, which is far better than whenever model is suggesting lower equity allocation. So as you can see that there's a clear trend that whenever valuations are cheaper, model will suggest higher equity allocation, and generally 1 year forward returns tends to be better. We have also mentioned minimum and maximum returns whenever model has suggested these ranges of equity allocation. Moving on. Moving on to gold. So when it comes to gold, taking a call on gold on individual basis is always very difficult, because typically we have seen that gold remains sluggish for very long period of time, and whenever cycle is in the favor, typically gold returns is far superior, right? And so taking a call on gold on individual basis is very difficult. And role of gold in multi-asset allocation fund is to minimize the portfolio volatility. And typically we have seen that whenever equity markets are trading at expensive valuation zone, typically risk on equity markets are higher. So we have analyzed performance of gold vis-a-vis equity. So we have come out with gold to equity ratio, which shows relative performance of gold vis-a-vis equity over long period of time. So as you can see that the gold to equity ratio tend to move both sides. So whenever gold has significantly outperformed in recent times, in that case, gold to equity ratio is higher than mean. And if gold underperforms as compared to equity, gold to equity ratio tends to be below mean, and it keep moving both sides. So using this particular analysis or study, we are deciding our gold allocation in the portfolio. So in the bottom table, you can see that whenever gold to equity ratio is cheaper, typically next 1 year gold returns are higher. And similarly, whenever gold to equity ratio is expensive, more than 3.5, generally gold returns are lower as compared to whenever gold to equity ratio is below mean. So there is a clear trend that one should be increasing gold allocation whenever gold to equity ratio is lower, and vice versa. Moving on. So here we have plotted our gold allocation, how it has changed in last 15 years. In last 1 or 2 years, it is pretty volatile. It is moving from one extreme of 10% to other extreme of 25%. In the month of Feb, we were having 23% gold allocation, but subsequently we have seen that gold has rallied about 20%. So because gold has outperformed equity, so model has suggested lower gold allocation in the portfolio. Current gold allocation is about 11% in the portfolio. In this particular chart also, you can see that there is a clear trend that whenever our model is suggesting lower gold allocation, typically next 1 year gold returns are lower, and whenever model is suggesting higher gold allocation, generally gold returns are better. So there's a clear trend on this particular side as well. Moving on. Right. So here we have shown performance of our asset allocation model. Assuming that whatever allocation model has suggested, had we invested that money in Nifty, underlying benchmark, then what would have been the outcome? So as you can see that the model portfolio has generated returns which are very similar to equity in last 3, 5, and 10-year period. But as compared to benchmark, which is 65% equity, 10% gold, and 25% fixed income, it has outperformed about 1.5–2% level in 3, 5, and 10-year period, depending upon volatility of equity market environment. Typically, in a volatile equity market environment, alpha generation from asset allocation is higher, and if markets are moving in one side, alpha generation could be lower. But the best part about the model is the overall volatility of the portfolio is also lower as compared to equity and underlying benchmark. So it helps you generate better risk-adjusted return, which is the primary role of multi-asset allocation fund, that it helps you minimize the volatility associated with a single asset class. At the same time, it helps you navigate those volatility in the equity market environment. So with an aim to generate better risk-adjusted return from longer term perspective. So we were discussing about asset allocation, how we are changing equity and fixed income, equity, fixed income, and gold allocation in the portfolio. I mentioned that we are using our in-house proprietary financial model to judge asset allocation in the fund. So when it comes to stock selection, so we use integrated investing approach, which combines fundamental research with market signals. So by market signals, we mean various styles which are performing well in the marketplace. So we analyze performance of various asset class such as momentum, volatility, fundamental factors such as quality, growth, and value, and at the same time various size factors such as large, mid, and small cap. Vetri mentioned that currently mid and small cap segment of the markets are trading at extremely high valuations as compared to large cap. So currently model is tilted towards large cap allocation. We were having about 50% large cap allocation about a year back, but because on relative basis, large caps are trading at much attractive valuation. So our allocation towards large cap has increased to about 75-80% now as compared to 50% about a year back. Moving on. So when it comes to fixed income, our approach is quality and liquidity. Large part of the money is invested in sovereign and AAA equivalent papers because we believe that large part of alpha could be made through dynamic asset allocation across equity and gold. So that's why we are not taking aggressive call when it comes to fixed income. I mentioned that we are analyzing various factors, and based on that, we are taking a call on the underlying portfolio. So let me explain you how various styles have performed in the market in the longer run. So the broader market cap based index, Nifty 200 index, has delivered 14.9% return in last 19 years, ever since we have data for these smart beta or factor based strategies. As compared to that, all these factor based strategies, be it momentum, quality, value, or low vol, have outperformed to the tune of 3 to 5%, right? And we are combining these four factors to come up with our stock selection. Typically, momentum is core part of the portfolio because we believe that India being a trending market, the outperformance from momentum portfolio is quite consistent. So momentum is a core part of the portfolio, but whenever momentum is trading at expensive valuation zone, whenever some of the segments within momentum are trading at expensive valuation zone, or the reversal is higher in some of the sectors, we take active call by reducing allocation to these segments of the market by investing some part in low vol or quality oriented portfolio. So we combine these portfolios to arrive at the stock selection in the portfolio. So I will stop here, and Niranjan, we can take Q&A.
Yeah, sure. Thanks a lot, Shravan, for such a detailed rundown on the strategy of multi-asset allocation fund, and also in terms of asset allocation in general, right? So now we will move on to take the questions which have actually come our way. So I'll also request the viewers to keep sharing the questions, and we will take as many as possible over the next 15-20 minutes or so. So, Shravan, the first question to you. So, could you actually help us to understand better in terms of the portfolio asset allocation framework, in terms of the number of frequency and also the quantum of tweaks that you do in terms of the asset allocation?
Sure. So we use 4-factor model to decide on asset allocation of the portfolio. So equity allocation moves from 10 to 40% depending upon relative valuations. Typically, we have designed the model wherein we are getting 4 to 6 triggers in a year, and we have decided a tolerance band of 7%. So every time we are changing asset allocation by 7%. We are not changing every now and then because we have weighed impact cost and execution cost while deciding on this particular tolerance band. And when it comes to position sizing, typically mid and small cap companies are limited to about 3%. And at the same time, we are mindful of size and liquidity in the portfolio. So companies which are very small in size, at the same time, while liquidity is lower, we generally tend to have smaller bets on those companies in the portfolio.
Yeah, sure. Thanks, Shravan, for that. Vetri, there is a question to you on the consumption story which is playing in India. So the Indian economy is actually projected to become the world's third largest consumer market by 26. The recent report says that, right? So, however, the consumption growth has actually lagged the investment growth in the, especially the last couple of years since the pandemic, particularly since mid of 22 onwards, right? So what are the headwinds that actually you see in terms of which are actually delaying the growth, and how is the earnings trajectory for this sector is also looking like?
Sure. So, I think that's a good question, Niranjan. And I think it's a good question because we have to understand that most economic trends always have an underlying element of cyclicality within them. When we extrapolate from today to 2047, it's very easy to extrapolate in Excel a straight line which doesn't show any volatility. But what history tells us is that economic growth always has its own cycles. There can be periods during which consumption could grow faster than underlying, economic growth, and there can be periods where investment might do better relative to, GDP growth. As an example, exports as well at some point could do better than GDP or could do worse than GDP. So there are cyclical elements. It is never that it is always a consistent straight line. That's point number one. I think we've already discussed in the past some of the reasons as to why consumption growth in India has been slightly weak, and this is simply a function of the pandemic in many senses. If you actually look at per capita income growth, so we are looking at each the GDP of the, not the total GDP of the country, but GDP per capita over a 5-year period ended FY24, the per capita income growth is only about 3% because of the setback that happened during the COVID period. 3% per capita income growth is one of the weakest numbers over a 5-year period compared to the last 30 years of historical data that we have, and I think that is the number which is causing the actual company numbers to look weak, because clearly consumers don't have the ability to spend because they are still sort of setting their balance sheets in order, or perhaps they have borrowed through that difficult pandemic time and therefore are trying to pay down those loans at this point of time. So it's hard to know all those reasons, but I also think that there is some reason to be slightly optimistic about the fact that so far the recovery has been what we have popularly called K-shaped, which means the top end of the pyramid has done very well, the lower end of the pyramid not so well. But we also know that some of the areas like real estate are picking up, and when real estate picks up, it tends to be a very good job creator in the short to medium term, and particularly it can absorb a lot of the surplus workforce from the agriculture sector, including unskilled labor force. So I would be slightly optimistic that we have perhaps seen the worst of consumption data. It could slightly start to turn marginally from here, but at the same time we have to be cognizant of the fact that consumers have gone through a difficult time. Maybe on a relative basis the valuations of these companies also needed to derate because they were trading at very high multiples even going back 2 or 4 years ago. So that has also contributed to some kind of underperformance by the stocks. But fundamentally the business models of many of our consumer companies are strong in terms of the kind of cash flows that they throw up, the return on capital that they have, and we know that in the long term the stock market returns of a business are closely related to its EPS growth, which is also a proxy for return on equity, and therefore I would look to that as being the long-term trajectory. But right now the cycle is yet to sort of turn up in terms of demand.
Sure. Thanks, Vetri, for that insight. So we will move back to the discussion on the fund. So Shravan, this is a question to you. So you mentioned that equity part of the portfolio follows the integrated investing, which actually combines the fundamental research with the market signals. So please throw more light in terms of the portfolio approach to these sectors that you actually tend to pick, and also do you have any exclusion filters for the stock selection?
Sure. We use integrated investing approach wherein we combine fundamental research with signals coming from the market using various factors that we have looked at. So we have 14-member research team which tracks about 400 companies. So they do track these companies based on various fundamental factors. So we combine that knowledge with market signals in terms of various factors. So as we have looked at that various factors perform well in different market environment. So we looked at that momentum is one of the consistently performing factor which has delivered about 5-6% alpha from longer term perspective. And typically in a market cycle which is much more stable, momentum factor tends to perform well on consistent basis. But whenever we believe that based on historical patterns, either momentum has significantly outperformed, or at the same time some pockets within momentums are trading at expensive valuation zone, or there's some crowding effect within those segment of the market, we don't shy away from investing some pocket of the money in complementary styles such as low vol or quality. So we combine our knowledge of these factor-based strategies, and accordingly we build the portfolio across different factors.
Sure. Thanks a lot, Shravan. So tomorrow being Akshaya Tritiya, so there are questions on gold as well, right? So the question is on the gold. So the gold price, in fact, have been scaling new highs for the past at least like a few weeks, right, across the globe. So thanks to the various factors, including weak macro economic environment, or it could be even geopolitical risk, or for that matter, the central banks buying the gold aggressively, right? So, what is your prognosis in terms of the gold prices as of today and outlook going forward?
Sure. So we have analyzed performance of gold vis-a-vis equity, and we found that both these asset class perform well in different market environment. Typically, half the time gold performs well as compared to equity, and remaining time equity is performing better than gold. So we analyze the performance trend between gold and equity, and accordingly we are deciding gold allocation in the portfolio. See, role of gold in the portfolio is to hedge the equity market volatility. So whenever equity markets are going through turbulent time, typically gold performs far better, because gold is considered as a safe haven. And during extreme equity market environment, gold performs well. And as you mentioned, that because geopolitical risks are emerging at the same time, global markets such as US and underlying economic growth in US is in a sense going through a slightly tough time. So that's why gold has performed well in the recent time. But in the multi-asset allocation fund, we use past trend, and accordingly we decide gold allocation. I mentioned that a couple of months back we were having about 23% allocation in gold, but because gold has significantly outperformed and gold to equity ratio has moved up slightly, so that's why our model has suggested lower gold allocation of just about 10-11% at this point in time. So it keeps changing depending upon relative performance of gold vis-a-vis equity.
Just to add to that, Niranjan, I think multi-asset positioning of gold is a relative positioning, because it has the option of equity, gold, and fixed income. So it has to choose as to where it thinks the best value lies. But just in an absolute context, I think, one of the things which is very visible, which Shravan pointed to, there has been a lot more central bank buying of gold. And one very straight line you can find for central banks buying gold is, I think, in the last 2 years after Russia's, conflict with Ukraine, what the US Federal Reserve or US government policy to sort of cut the ability of Russia to access its foreign currency reserves has actually made countries all across the world question the wisdom of having all their reserves in dollars. Because if you at some point have a conflict with the US, then what is the safety and security of your ability to access those reserves? And I think this is something which any government in any part of the world must be thinking about, that today maybe we have friendly relations with the US, or maybe today we already have a conflicted relation with the US. Then how safe is our money sitting in US dollar reserves if tomorrow they can disconnect us from our ability to access those reserves? So I think that is a structural factor which is underpinning gold, and that is why you are seeing more central bank buying. And that's, I think, a longer term structural theme which will certainly benefit gold, other than what we already know, which is that it's typically a good inflation hedge.
Great. Yeah. Thanks, Vetri, for adding to that. So the next question to you, in fact. So, the widely anticipated rate cut bonanza has been put on ice as of now, right? So, and this is actually in contrary to the expectation of sharp rate cut expectation, which was actually there during the beginning of this year. So, if the rates are going to stay higher for longer, how is it likely to impact the equity market performance, and particularly the quality or high growth businesses which have actually waited for so long, for more than 3 years now, so with no signs of recovery? Yeah, so if you can throw some light there.
Sure. I think the first point to make is that it is not possible to drive a straight line between these two, Niranjan. Certainly, high cost of fixed income will have an impact in terms of it impacting those who are looking to borrow. So far, the impact has been limited in the US, particularly on the US consumers. US balance sheets are reasonably strong, but the US government certainly gets affected by these higher interest rates, and therefore a larger portion of their tax revenue will then go towards meeting their debt burden. So that is a direct impact that higher interest rates have. As far as the impact of higher interest rates on valuations is concerned, obviously the higher the rate, the more the impact on valuations in terms of being a downdraft. But I will admit that this has not worked particularly well over the last 1 year, because if you actually look at the Magnificent Seven in the US, excluding Tesla, those companies have actually seen their market valuations move up further despite cost of capital moving up. So net high cost of equity is not a high cost of debt is not good for equity. You know, those of you who maybe heard Warren Buffett at his AGM last week would have heard him say that if he's able to get 5.5% on his cash from the US Treasury, then there is no great compulsion on him to go out and invest. So, you know, I always say that high interest rates in fixed income are a magnet for investors, and particularly for US investors who have never seen these kind of returns in fixed income for maybe 10, 15 years, actually post GFC, they have never seen these kind of returns. So it is actually a magnet for, money to move towards debt, particularly as far as asset allocators are concerned. Some drag on valuations will obviously happen because of rates being higher for long.
All right. Yeah. Sure. Thanks, Vetri. So, Shravan, you actually mentioned in your deliberation that UTI multi-asset allocation fund is ideally suitable for investors who are looking for balancing risk and reward. However, what should be the ideal allocation to this fund as compared to the one's overall portfolio, and also what should be the preferred approach for investing? So either lump sum or SIP, if you can throw some light.
Sure. See, multi-asset allocation fund provide access across equity, fixed income, and gold, and that too in a systemic manner, driven by valuation-oriented factors, right? So I would say if somebody who wants to just invest in a single fund, that multi-asset allocation could be that fund, right? So allocation depends upon how closely investor is monitoring the market, which segment of the market he wants to invest. But I'm saying that from longer term perspective, if you want to invest in a tax efficient fund, then multi-asset allocation fund is one such fund, because any rebalancing from one asset class to another does not entail any tax on the investor, either directly or indirectly. So for example, if somebody investing in multi-asset allocation fund today and redeeming after 10 years, so he is paying equity taxation, which is 10% capital gain after 10 years. Within this 10-year period, there is no direct or indirect taxation, although fund keep changing allocation from one asset class to another asset class. Same thing if investor is trying to do at his or her end will lead to a lot of taxation, because whenever he is shifting from one asset class to another asset class, there are a lot of tax incidents. So multi-asset allocation fund provides you single route access across different asset class which are having negative or low correlation to each other. So if somebody wants to generate stable return for a very long period of time, multi-asset allocation fund is very suitable for such investors. And when it comes to the approach of investing, typically we advise people to invest in equity oriented funds using SIP route, because you want to capture different points of the market. But balanced advantage fund or multi-asset allocation fund, which are investing across various asset class depending upon relative valuation approach, are suitable for investing through lump sum as well, because the asset allocation is handled by the fund itself rather than investors. So you are not concerned about whether I'm buying 50% equity or 70% equity or what are the valuations. That is taken care of by the fund itself.
Great. Yeah, thanks, Shravan, for that. So there is a question from one of the investors, perhaps. So his question is primarily, so he's asking, would the fund also be investing in silver or other commodity? In fact, that is also, in fact, done well in the recent past. So if you can add to that.
Sure. See, three asset class which are having negative or low correlation to each other are equity, fixed income, and gold. Right. So typically negative correlation of gold vis-a-vis equity is highest. Silver correlation vis-a-vis equity is not that high. The correlation of gold vis-a-vis equity is minus 0.5, which is one of the highest across different asset class. Because typically whenever equity markets are going through tough time, because gold is considered as a safe haven, generally gold provides a lot of protection at such times. And if you look at characteristics of silver, about 50% of silver uses are for industrial purpose, which is directly linked to equities and asset class as well. And only 50% is considered as a precious metal. So it is not having very high negative correlation to equity. And aim of multi-asset allocation fund is to invest across different asset class which are having negative or low correlation to each other with an aim to generate better risk-adjusted returns, because asset class which are not correlated to each other helps you to generate better risk-adjusted returns in the longer term perspective.
Sure, thanks, Sean, for that. So the next question is to Vetri. So the PSU basket of stocks have actually re-rated significantly over the past few quarters, right, Vetri? So amid the large valuation discounts which they had, and perhaps high dividend yields that they are actually giving, and also plausibly the possibility of a privatization of some of the names, right? So, but do you think this trend is going to sustain or continue for long term? And also, do you expect or is there any risk for the growth sustenance of these businesses?
Sure. Yeah. Thanks, Niranjan. What I always say is, look, the case for investing is ownership dependent only up to a point, because it's actually driven more by how the fundamentals of that business compared to how other businesses in the same domain are performing. So I don't think of PSUs as a basket, just like I don't think of investing in, argument's sake, the Tatas as a business or the Birlas as a business, because that is not the way you invest. You look for companies which have a competitive franchise, which have the ability, they have the right to win, they are competitive in the businesses in which they operate. They obviously need to have good management, and then you want them at the right valuation. So in that sense, whether the management is PSU or private actually has no relevance. I think PSUs as a basket, we know for many reasons, were trading very, very cheap relative to their private sector brethren for many years, and particularly 2021 seems to have marked the inflection point where their valuations have moved up. Good, but I would still say better to be stock specific rather than try to play the basket, because then you would be perhaps arguably be buying the wrong company as well, and that's not a good reason to invest.
Yeah, thanks, Vetri. So in the interest of time, we will take last two questions for this evening. So Shravan, this is a question to you. So the fund actually follows the UTI multi-asset allocation fund, following dynamic approach to asset allocation along with integrated investing approach to equity portfolio, has actually given good performance in the past, right? So can this fund be a substitute to smart beta index funds? And also, if you can throw some light in terms of how should be investor looking to allocate between the passive funds or multi-asset kind of set of funds?
Sure. So UTI multi-asset allocation fund is a dynamic asset allocation fund which invests across three different asset class. But when it comes to smart beta or factor-based investing, they are pure equity-oriented fund. So within multi-asset allocation fund, the equity part is designed based on various factors, right? We discuss how different factors have performed from longer term perspective. So we allocate money across different factors depending upon relative opportunity and relative attractiveness of these factors. So the equity part of the portfolio within multi-asset allocation fund is using that particular study and knowledge, which is how different factors perform in different market environment on active basis. So when it comes to smart beta investing, different factors perform well in different market environment. So we advise people to combine various factors. So typically we have studied various factors when we found that, say, momentum and low vol or momentum or quality is having complementary styles. Typically, momentum performs well in a stable equity market environment, and whenever markets are trending, momentum as a strategy is performing well. But whenever market exhibiting a lot of volatility, quality and low vol kind of strategies have done better. So we are advising people, whenever it comes to smart beta or factor-based investing, you should combine two complementary styles to get stable outcome from longer term perspective. And similar outcome we are using in our multi-asset allocation fund when it comes to stock selection.
Sure. Thanks, Shravan. So one final question for the evening. So this is to Vetri. So in fact, Vetri, the funds following quant strategy over the last couple of years have actually delivered reasonable returns to the investors, right? So how is UTM MAF in-house quant strategies actually different from its peers? So if you can throw some light, and also do you see more funds actually adopting the quant strategies going forward for portfolio construction? And also, lastly, how should actually investors look at allocating to quant strategies vis-a-vis the funds following fundamental research? Battery or on mute. Yeah.
Quantitative methodology driven investing does exist across the world. It has a space, it sits somewhere between active and passive because it is more rule based in some sense, it is algorithmic in some sense. And at the same time, it does involve some bit of, active decision making. We effectively launched this strategy, relaunched the fund, which is our multi-asset fund, with this strategy going back all the way to March of 2022. So we have been running it for more than 2 years using this approach. I think it adds a further dimension to what we do because it is clearly an active approach as compared to the standard passive approaches. By the way, we have a large offering of passive factor-based approaches as well. But this really combines active investing with passive. And the way we do this is really to be able to then try and identify, where there are risks in quantitative investing, how to manage those risks by using different factors which are available to us, how to try and optimize performance by using different factors which are available to us. And therefore, I think it creates a very interesting proposition for the investor to use this methodology, which combines, as I said, factor-based investing with a slightly active approach. So this is something that we will certainly look to support as UTI. We have already done this investment over the last 2 years, and hopefully we will expand the range of funds which will be available to investors who want to use this as a very good way to try and sort of tackle market challenges and market volatility.
All right. Yeah. Thanks, Vetri, for that. I think we have reached the end of the webinar today. So thanks, Vetri, Shravan, for your insights, and also viewers for your participation and also actively sharing your questions. It always helps us to keep the webinar engaging. So just a request to the participants here today. So please use the feedback link, which is available on the screen, to share your feedback on the topics that we actually covered today and also webinar in general. So it will always help us to do better in our future engagements. So with that, thanks everybody. Have a great evening and thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.